My name is Uday Turaga, and I'm with ADI. Welcome to our weekly webinar series. This is something that we've launched since the past few weeks, given the current crisis that the oil and gas industry is in. Today, we'll talk a little bit about natural gas and LNG and what we see happening in those markets in the current situation. Very quickly, for those of you who don't know us, ADI is a boutique consulting firm focused on oil and gas, energy, and chemical markets. We've been around for the past 11 years. Within these markets that we serve, we work across the value chain. So in oil and gas, we work in upstream, midstream, and downstream markets, for example. Over the past 11 years, we've worked with over 150 clients. We do a lot of work with the larger oil and gas majors and operating companies, but also serve a number of companies that sell equipment and services into the oil and gas market, and also a number of investors and early stage companies active in these markets. In terms of the way we support clients, we can help them in multiple ways. As a boutique consulting firm, we bring a lot of industry expertise as well as a lot of flexibility. So we have the ability to serve clients in multiple ways. Very briefly, we can help companies with market research and strategic planning support. We have a lot of proprietary analytics and databases that we can use for pricing and cost and economic analyses. We've supported a number of companies with transaction advisory services, as well as supporting them with their portfolio analysis and optimization work. And then, of course, a number of other areas in which we can be of support. Natural gas and LNG markets is an area where we particularly bring a lot of expertise. Some of our recent work has included work for an E&P independent, helping them understand what production will look like in the current environment, as well as various scenarios going forward. Some of the more recent work that we did earlier was helping one of the large oil field service majors with developing a supply strategy focused on fueling their frac fleets and drilling equipment with natural gas and some of the US shale plays. Some of the work that we've done earlier has been focused on helping an Australian oil and gas company with developing a strategy to supplement gas production for LNG exports. A lot of the gas production in Australia, we are seeing declines, and we've supported them in the past on some of those things. In addition to the operators, we do a lot of work helping equipment and industrial and service companies. And one of them that we supported recently was helping them develop a growth strategy focused on identifying opportunities in 20+ equipment and service market segments, all within the oil and gas and LNG market space. And then finally, supported due diligence work on a major LNG export project around a transaction with a private equity investor. In addition to consulting work, we offer quite a bit of research and data and analytics services as well in natural gas and LNG. Since 2013, we have been producing the North American Small-Scale LNG Report. That's an annual study coupled with quarterly research service support. This year, we've launched a global small-scale LNG report. We are currently working on a big project with the US Department of Energy, helping them identify small-scale and containerized LNG opportunities that can be exported out of the US into Eastern and Central European markets. And some of that work builds off of the extensive work that we have done in small scale and micro scale LNG markets. And we've decided to kind of offer a new product offering, research offering, focused primarily on small scale LNG on a global basis. In addition to that, we maintain a LNG benchmarking tool. This is for new capital projects. We've had this tool since 2011, where we rank all the global LNG project announcements and have the ability to segment them based on various metrics. This is particularly valuable for companies that are serving the LNG market with equipment and services to understand where they can prioritize their efforts and which projects are likely to go forward. Of course, in addition to these services, we maintain a large number of data sets and analytics tools focused in and around the natural gas and LNG markets. For those of you who've been following us, you've probably seen a lot of our research focused on analyzing what is happening in the oil and gas market today, given the multiple pressures from the oil price crash, as well as demand destruction coming from COVID-19. We've set up a dedicated page where all of this research is featured. We strongly encourage you to go take a look at it. The 3 great papers that we've published looking at these issues. More are coming. We have a team that's working exclusively on a lot of these issues. And then finally, we have these weekly webinars. The first tranche of webinars was announced a few weeks back. We are, I think, in the 4th or the 5th of those webinars. There's a couple more webinars next week's focused on petrochemicals and plastics, and the following week on utilities. But we have also announced a second tranche of webinars. We intend to continue these Thursday weekly webinars because the industry needs a lot of support in terms of research and analysis, and we want to do our bit in terms of sharing how we think about these oil and gas markets. If you want to delve deeper and get more granular insight that you can readily use to shape your strategy, we have a new research report that's helping clients navigate this perfect storm. We talk a little bit about some of the background and what the outlook for demand destruction looks like. And then we do these deep sector dives in upstream, midstream LNG, petrochemicals, natural gas and LNG and refining markets. And then we do forecasts around capital spending, operating spending, and also implications for investors. So get in touch with us if you'd like to get into a little bit more detail around some of our research focused on what's happening today in the oil and gas markets. I'm joined today by my colleague Panusvi Dwivedi. She's an analyst with our firm. She has worked on several gas and LNG focused projects over the last few years. She's going to share a little bit of her thinking, especially working on some of the ongoing LNG projects at our firm today. But before we get there, let's quickly go through some insights in terms of how we see natural gas and LNG markets today. So if we look at, we have supply and demand here in the US. The supply is on the left side, and you'll see that there's been not much of an impact on supply. This is in billion cubic feet a day. Since the beginning of the year, we're pretty much at some sort of a steady clip. I think as rig counts start falling and as some of the production, some of the drilling activity actually starts falling off, which is something that we are seeing right now, we should see some sort of a decline in supply going forward. Now, some of the oil production is hedged, and because of that, we'll continue to see some associated gas coming onto the market. Similarly, some of the gas production is hedged. So then I think supply is probably going to decline a little bit. Supply is going to decline more slowly relative to, let's say, what we are seeing for natural gas demand. And we have natural gas demand on the chart on right. You can see that we are seeing a pretty significant decline there going forward. A lot of that is driven by residential and commercial markets, which is this violet colored tranche, purple colored tranche that we see here. In comparison, power, which is the first segment here, we've seen some sort of a small decline. We haven't seen as much of a big decline there, but eventually we do expect some of that decline to come in, especially as industrial markets start declining. But after residential and commercial, the other segment that has seen a decline is this light blue segment here, which is industrial demand for natural gas. And we have started seeing quite a bit of decline in industrial markets as well. In comparison, LNG exports, which is the tranche at the top, continues to be reasonably robust, but we'll get into a little bit more detail on some of the challenges LNG exports will see going forward. And this blue line or blue band here right under LNG exports is pipeline exports into Mexico, and that has remained fairly resilient so far. One of the features of the US natural gas supply market has been the share of associated gas. The bulk of the growth in gas demand over the last few years has been driven by associated gas production. This is gas that is produced along with oil. It is gas. The break-even economics of associated gas is negative in the sense that it is being produced irrespective of what the prevailing price of natural gas is, primarily because the wells are being drilled and produced for oil, and gas just happens to be a byproduct. Because we anticipate up to 2 million barrels per day of oil supply cuts here in the US happening over the next few months into late 2020, early 2021. We expect some of this gas production to fall, associated gas production to fall, and that will have some sort of an impact in terms of overall gas supply going forward. So we've revised our forecast for shale gas production here in the US, and you'll see that the big plays like Permian that have accounted for the bulk of growth and which are all dominated by associated gas will see pretty significant declines. We'll also see some sort of a small decline in Marcellus, which is predominantly dry gas. There's some portions of Marcellus that have NGL and liquids-rich gas, but in general, most of the Marcellus production is on-purpose gas production and is not associated gas production. We will see some sort of declines there as well. But the bulk of the reduction that we see in the next couple of years is going to be driven by associated gas reductions. One thing to note is that we anticipate some sort of a decline here in the next few months, but actually the real decline in gas production we are forecasting right now to happen in 2021, because that's when the full brunt of declines in drilling and completion activity will actually come to the fore once a lot of the hedges that we have right now for current production levels start running out. Collectively, because of this decline in supply, especially decline in the supply of associated gas where break-evens are negative, we think that gas prices are going to increase. Of course, they're still going to be below the 3.25 million BTU that we have in the past few years, but we anticipate gas production to increase over the next few years or so. Line in between the range of forecasts that we have shown is we've labeled this as ADI estimate, but it's a very simple assessment there. All that we have done is taken an average of the futures forecast, the futures prices for natural gas. So we see that some of the uptick in natural gas prices has already been factored into the market. And that's why you also see some of the gas-focused Appalachian gas producers having a better time in the stock market relative to, let's say, a lot of oil-focused E&P companies. Of course, not everything is, looking, better, I guess, on a relative basis. LNG is a particularly difficult market right now. We have monthly averages of LNG prices here, and you'll see that historically we'd see nice big differentials in the European and the Asian markets relative to Henry Hub. We obviously have been going away from that in recent years, and we have seen a complete collapse in the last few weeks. These are monthly averages, so you can't quite see the granularity here, but in some weeks we have seen European prices being lower than that of Henry Hub. In other words, there's absolutely no arbitrage to move gas as LNG from the US into European markets. And I think this collective pricing trend is going to have a pretty significant impact on overall LNG markets, both here in the US as well as globally. This is unfortunate because LNG has accounted for a significant share of growth in US gas demand. This is feed gas flowing to US LNG terminals. You will see that has been increasing in 2019 at a significant clip. and it has been a very robust 8.5 billion cubic feet a day for the year to date in 2020. We anticipate this number to go up by another 1.5 billion cubic feet a day in the next few weeks, because the third trains at both Freeport and Cameron are both coming online in the next few weeks. And we anticipate this number to go up significantly. But there's been, of course, as we all know, significant impact on gas demand, especially in Europe. And that's going to change some of this picture. Now, of course, one thing to keep in mind is even going into the year, LNG markets were significantly distressed. They were oversupplied. This is a view of the global LNG demand and supply market that we had shared at the ADI forum in January. We have revised that further. This bar was a little higher in 2020. We've brought that down. But essentially, we anticipate the next 4 or 5 years, the global LNG market will be significantly oversupplied and potentially continue to be oversupplied into 2025, unless the high case of our demand scenario comes into fruition. Of course, it's hard to predict what's going to happen so long out in the future. But in general, when we look at prior recessions, it takes a while for the markets to start picking up on gas demand. And we see some of that here in coming out of 2010 and into, say, 2015. We did not quite see the increase in LNG supply that we saw, let's say, for the prior 5-year period. So I think that's something to keep in mind, is try to see what can we learn from prior recessions to understand what recovery might look like in these markets going forward. Another near-term challenge for LNG markets is cargo cancellations. If you've been following some of the news, you would have seen that a significant number of cargoes from US LNG exporters have been canceled. Customers have contractual flexibility that allows them to let liquefaction companies know that they wouldn't be taking or wouldn't be needing cargoes, and a number of those Asian and European customers of some of the LNG players here on the Gulf Coast, Cheniere and Freeport, have been notified by their customers that they would be canceling cargoes for the month of June. Cargo cancellation notices for the month of June were due April 20th. So a lot of those notices have come in. Collectively, I think the current number of cargo cancellations are around 20, 22 or so. We've modeled a little bit what those cargo cancellations mean in terms of utilization rates for LNG export capacity here in North America. And some of that is shown here on the chart on right. So if you take the 2020 year-to-date average, we are at a little over 8.5 billion cubic feet a day of gas that is being exported. We anticipate, because of the new startups of the third trains at both Freeport and Cameron, another about 1.5 billion cubic feet of exports come on stream. But assuming 20 to 25 cargo cancellations, we see anywhere from 2.5 to 3.25 billion cubic feet a day of gas production that won't be liquefied and exported. Now, it is possible that Cheniere and Freeport might still liquefy some of these cargoes and try to sell that in the spot market on their own. They have that flexibility within their contracts. But collectively, we anticipate something like 6.75 or so, almost 7 to a little over 7.25 billion cubic feet per day of liquefaction and exports that's going to happen in June. So essentially, bottom line is we anticipate something like a 25% to 35% cut in utilization capacity, unless, of course, Cheniere and Freeport decide to still liquefy some of these cargoes and move forward. What will be interesting is to kind of track what happens to these cargo cancellations beyond June, and that'll have some insight and impact in terms of overall utilization rates of LNG exports here in North America. Another good question to ask at this point is what happens to the pipeline of projects. We think that the project inventory based on FIDs right now will continue to hold. A lot of them are backed by fairly well-positioned players, and we expect a lot of this capacity to come on stream on time. There probably will be some delays, just given the history of delays in the LNG market that we have seen around new projects. But conceptually, we don't see any change to the project forecast in terms of new projects coming on stream. Now, of course, there's a number of other projects that have been announced, and we expect those projects to be challenged. Even going in, those projects had significant challenges in the sense that the advantages that the first wave of LNG export projects enjoyed don't necessarily apply for the second wave. So, for example, in the first wave of projects, the tolling model was very helpful in limiting a number of risks for companies like Cheniere. Because it was a relatively new offering in the market, financing was much more friendlier. Today, ESG concerns and some of the issues associated with the broader oil and gas markets make financing of new LNG projects a lot more challenging. And then finally, because a lot of these first wave projects were first to market, they had advantages in terms of attracting counterparties and customers of LNG, especially from Asian economies that were very interested in diversifying their energy mix. I think the next tranche of projects will have to fight harder for their share of the global LNG market, especially when it is oversupplied. And we expect those projects to be challenged going forward. Now, having said that, we still think that there are some fairly interesting projects. This is a sanitized view of some of the work that we have done through our LNG benchmarking tool, where we take the entire inventory of LNG projects that have been announced and put them through a number of analytics and come up with a view to say which of them are better positioned in terms of time to market, as well as their overall project competitiveness. So this includes costs and economics of the projects themselves and how much offtake they have secured, while time to market is a function of where they are in the regulatory and construction timeline. So although we think that most projects are relatively undifferentiated, we do see some interesting opportunities, and happy to get into some of the more specific details around some of these projects if some of this is of interest to us. Is of interest to you. Going forward, one of the big questions that everybody is asking is what happens to gas and its relative competitiveness as a bridge fuel or as a fuel for power generation. Even going into this market, we were seeing significant pressure from renewables for natural gas-based power generation. These are, we have on this page auction prices for onshore wind and solar, and you'll see that recent auctions for wind have been very much in that band where gas combined cycle has typically operated in terms of break-even costs, and we've also seen a similar trend for solar photovoltaic-based power generation projects. So I think gas was already under pressure going into some of these. So it's worthwhile to kind of think about what happens to gas and its competitiveness going forward. Clearly, the depressed LNG prices might help, but some of the low prices that we see in LNG markets are also a function of oversupply in the market. Going forward, we anticipate LNG export terminals to reduce their utilization rates, and as a result, some of that pricing might pick back up, which may put LNG back into direct competition with some of these renewable projects. Of course, a lot of these renewable projects continue to be subsidized to a certain extent or enjoy some incentives from government agencies around the world. Given the economic pressures that we are in right now, we anticipate some of those economic incentives might be scrapped, which might potentially make some of these projects a little bit more difficult. In general, when we look at the 2008 recession, Overall support for decarbonization declined during the recession, and it's possible that that might happen, especially if we head towards a recession here by the end of the year. So I think there are lots of factors and lots of moving parts to really come up with a definitive view on the competitiveness of natural gas at this point of time. But a lot of the risks that we saw going into the year continue to play an important role. I think in terms of greater penetration of gas in the global economy, we see the primary opportunity as displacement of coal. Although coal demand peaked, there's a significant amount of coal-fired power generation capacity that is coming on stream, especially in Asia. All of this could be fertile target for displacement by natural gas, but it's unlikely to happen without policy support. So unless there's a broader commitment and acceptance of something like the Paris Accord, it'll be difficult for natural gas to automatically enjoy some sort of an advantage over coal in some of these market segments. So I will pause there with the prepared insights that we wanted to share with you today. I'll at this time bring in my colleague Panusvi Dwivedi, who will help us at least share some of her insights on some key questions. In the meantime, if you have questions, please type them in the chat box, and we will be happy to address them here. So Panusvi, maybe let's start here with a couple of questions that we had identified here. So we talked a little bit about US LNG projects and what is the outlook for them. Obviously, we benchmark through our LNG project benchmarking tool, the global LNG project landscape as well. How do you see that market? Honestly, I think you are muted.
Yeah, I keep getting muted. Okay, now.
Okay.
So overall, looking at the global LNG capacity, we see that it's definitely been hampered by the current situation. We see that out of 225 million tons per annum of liquefaction capacity that was expected to undergo their FID by the 2020 has been reduced by almost 30%, 35%, and we see that only 79 million tons per annum of projects have been delayed due to the current situation. We are expecting more delays to be announced. And one example that we is BP recently announced a force majeure on the FLNG order that they had. They were going to expect it by 2022, but they're saying that they cannot accept it anymore. Closer to home, we see that Sempra LNG has also delayed their Q3 FID 2020 for Port Arthur LNG in Texas. And we also see that looking at the operational projects, Shell has decided to cut down their LNG capacity by almost 14% this year at their plants in Trinidad and Australia. So we see that it's been negatively impacted by the current situation.
Okay. One of the things that we have been talking about on some of our projects is what's happening with oil and gas price correlation and what that looks like today. So we thought it might be worthwhile to chat around that a little bit. So in general, right, I mean, historically, if you go back more than 10 years, oil and gas prices have been correlated on a BTU basis, the price similarly. But of course, after shale gas, we saw that correlation getting, we saw that correlation first weaken, and then eventually it became gas and oil prices were priced almost independently here in North America, which is why there was a significant arbitrage to kind of take natural gas, convert that into products like LNG or other chemicals and fuels, and price, which are priced at, on an indexation that is linked to oil. And that was the opportunity set. We expect that overall trend to continue, in the sense that oil and gas prices won't be correlated, at least in North America. But we are clearly seeing greater commoditization happening, let's say, in LNG markets globally as well. And so some of that might spread into other markets as well. Of course, in the near term, so long as oil prices are low, we'll probably see some sort of a correlation, but that's not necessarily driven by fundamentals around supply and demand, but it is driven because we are in a situation where overall economic demand has been depressed significantly. So, Manusri, one of the things that you've been working on in general has been on gas conversion. How do you see the gas conversion project landscape right now?
So, although the fact that we see gas prices have, we've seen a downfall in gas prices, but as we expect, they should be back in around the $3 per MMBTU price range pretty soon. And we see that currently we might think that this is a favorable feed, like a feed cost point of view. But historically, we've seen that talking about gas to methanol or other gas to fertilizer plants, they have been very high capex projects. And eventually, all of these are being driven by the demand, which we see is not picking up anytime soon. So looking at the current market scenario and those economics of demand and the cost per unit of these plants, they are not in a very favorable scenario currently.
Mm-hmm. And what about like gas and LNG in the long term, right? I mean, how do you see that? What is some of our research and analysis saying there?
So yes, we do see, like we discussed during the presentation, that the short-term demand is not looking very good or not very optimistic. But if we talk about the European and Asian markets, and if we see when they gradually start getting back to normalcy after the effect of coronavirus, we see that it's going to be a spike in the demand. And I say a spike is because they're going to try to count for the deficit that they've experienced in the last couple of months. And also talking about the high sustainability growth, we see that from the European market, like you mentioned, we've been doing this study for USDOE into the scope of small-scale LNG in the Central and Eastern European region. And we see that not only will the US small-scale LNG demand be driven by the demand growth, but it will also be driven by their desire to introduce decarbonization efforts and also to possibly displace the existing supply and looking for diversifying their natural gas supply. So we see that in the long term, there is a sustainable demand for a US LNG.
Yeah, so there's a question that came in that's is related to a little bit to this point, which is like what happens to, or what is the potential of displacing diesel with LNG at the small and micro scale. And I think when we look at small scale LNG opportunities, we see that to be a very fragmented market, right? We see some projects that are displacing diesel with LNG, but we also see some projects where people just want LNG as a backup fuel that's available for them. They're currently using pipeline gas as a fuel in industrial applications, but they want to have some LNG as a backup in case their gas supply gets disrupted. And we see some of those in particular in European industrial markets where the decarbonization pressure is a lot more intense. But I think in places like the Caribbean, in some of the more critical infrastructure where diesel-fired backup continues to be a big player, we are slowly seeing interest and opportunity to displace that with natural gas and LNG in particular. But I think a lot of that will be primarily in larger industrial market segments. The last topic that we want to talk a little bit about is gas-focused midstream. I think we covered some of this in the midstream webinar earlier, but when you look at the midstream market, the 3 or 4 ways to kind of break down the midstream market. There's crude oil based, there's gas focused, there's LNG, and then there's the gas processing and NGL market. In general, the gas focused midstream market is better positioned relative to some of the other midstream markets, because these pipeline assets, for example, in that ferry gas from point A to point B, have longer term contracts. They are underwritten by longer term relationships with the counterparties. And so that collectively, and then there are also minimum volume commitments that these counterparties commit to. So that's one example why some of the gas focused midstream is probably better positioned relative to some of the other assets. There are a couple more questions here. One is it too optimistic to predict $3 a million BTU? I think given where we have been, I think over the last few months, I think it's a fair question. It makes sense that it's probably $3 a million BTU is probably too optimistic. But I think we anticipate pretty significant declines in supply coming in here, especially from the Permian. Coupled with that, we anticipate some sort of an uptick, at least in some of the industrial markets, especially as recovery starts coming up. And collectively, based on that, we think that it seems $3 seems feasible right now, $3 a million BTU. Of course, the market's also pricing some of that in, right? We are not necessarily saying that's a blinding new insight from our firm. We see that in futures prices as well, where it slowly kind of ramps up over the next few quarters up to $3 a million BTU. There's another question on ethane. There's a glut of ethane in North America. What are companies planning to do to get rid of excess ethane? I think generally speaking, our assessment is that at least in the near term, until the petrochemical markets are in full-fledged recovery, we anticipate ethane to be rejected, and rejection will continue to increase through the near term. But eventually, we anticipate NGL markets to actually potentially get supply constrained as production falls, oil production falls, Permian and some of these other places that have become large suppliers of NGL volumes and have accounted for a lot of growth in NGL production. NGL production there will decline, and so that will eventually potentially lead to reducing rejection levels once we are into the recovery phase. But I think for the near term, I think it's all going to be rejected into natural gas supply at this point in time. I think we are at time now, so with that we will wrap this up. Again, if you are interested in a little bit more granular insights and more specific guidance in this market, we suggest you take a look at our new report. As I said, our next weekly webinar next Thursday is on petrochemical and plastics markets. Following that, we have a webinar on power and utilities, and then we have announced a new tranche of webinars again every Thursday, same time, 11 a.m. This time we want to get into some of the specifics around the different market players. So our first webinar will focus on leveraging some of our consulting experience on how industrials and OEMs can prepare for the downturn. We'll talk a little bit about the capital projects landscape and EPCs in particular on May 28th. And then early June, we'll talk a little bit about what the new normal will look like for oil and gas markets, and follow it up with renewables and a look at oil field services. So lots of stuff coming up. Please continue to sign up and join us at these webinars. You can sign for all of them up on our COVID page and the links there. With that, thank you for joining us today. I appreciate your interest and support, and have a good rest of the day.